Hey everyone, thanks for tuning into this episode of the Real Estate CPA podcast. I hope everybody had a happy new year and a great holiday season and are ready to crush 2022. Your host, Thomas Castelli here, and we're joined with Justin Shore, one of the senior advisors here at the Real Estate CPA, who will be filling in as co-host for Brandon. In today's episode, we're going to discuss whether or not landlords should establish a home office. Believe it or not, we get a lot of questions about this topic, and there is some confusion out there in the real estate community, and we're hoping to clear that up today. All right, so diving right in here, we're going to talk about, do landlords actually qualify for the home office deduction? I think the answer, of course, is it depends.
It depends on whether or not your rental activity is rising to the level of a trade or business.
Right. So not all activities rise to what's known as a Section 162 trade or business, which for our purposes here, we can just consider that your normal, just a normal trade or business, or a Section 212 activity, a 212 activity, which is basically an activity that generates income, but is not a trade or business. And to make a long story short, trades or businesses can claim a home office. If you don't have a business, then you can't take the home office deduction for the most part. And I think what it comes down to is whether or not your rental activity rises to that level or trade or business, or if it's more or less an investment that you don't really play much of a role in, then in those cases, for the most part, you're not going to be able to take the home office deduction. And the good news is we have this all backed up by a case. So the case was Curfee versus Commissioner, and to make a long story short, he was a doctor, and what he did, he owned 6 rental properties, and he self-managed these properties. So that means that he was responsible for furnishing some of these properties, as well as finding tenants, coordinating repairs and maintenance, the typical type of things that you would see a property manager do. And because he was able to self-manage these properties, the tax court ultimately found that it rose to the level of a trade or business, and therefore he was granted a home office deduction. So that's good news for landlords. If you are basically managing your property and you're taking basically playing an active role, there's a good chance it's going to rise to a level of a trade or business. But of course, you're going to want to discuss that with your own tax advisors just to make sure, because there really is no bright line test. Assuming your rental activity rises to level of a trade or business, the next question is whether or not you should actually take a home office deduction, or do you actually get the deduction itself?
Yeah. And, one of the issues that commonly comes up, and I've heard like a lot of our clients will even kind of bring up is, I don't take that deduction because, I've been told that I'm not going to be able to anyways, because thanks to depreciation, my properties are producing a tax loss. So I'm not going to be able to take the deduction anyways. So, they kind of have this, then what's the point?
Right.
If I can't take it anyways. And so they're kind of, first fallacy there is that, yeah, you may not be able to take that deduction in the current year. It's going to get carried forward into future years as well. But the other kind of component or the detail with this is that even if you're not able to take that deduction, the fact that it is being paired so closely with enabling you to take more of your travel deductions that are related to your local area, it can still be very significant. So it could still be basically opening the door or opening the window for additional deductions. So you don't want to be closing yourself off from that potential either.
Right. 100%. So basically, the home office deduction is going to be limited to the income that's generated from the activity. And as most landlords are out there, you probably have between your depreciation, like Justin said, your other expenses, you're probably generating a loss for tax purposes, which means, unfortunately, you're not going to be able to take the home office deduction, at least today. And it's going to get carried forward to future years when at some point you might be able to use it. But the big takeaway is that when you're making your home a place of business, and that's something very key, because what happens is if you were to drive from your home to your rental property, which your rental property is a business location, or to the bank for business or Home Depot or wherever, it's going to be considered a personal commute because you're driving from your personal residence to a business location. So that first commute of the day is going to be a personal commute. And those miles, if you drive a car or a vehicle, are not going to be considered business miles. However, when you establish the home office, you're making your home a place of business. And now the travel your home, from your home office, a place of business, to that rental property, to Home Depot, to the bank, to the lawyer's office, wherever, is going to become a business mile and is now going to be tax deductible. And that's going to be key to maximizing your vehicle related deductions, as we're about to get into right now.
And those details are also solidified and backed up in the Curfee case, because the IRS was taking the stance that his place of business was where his full-time job was as a dermatologist. But the tax court actually ruled in his favor on this particular detail as well, by saying that you can have more than one place of business especially if you have more than one business. He was a dermatologist, was in that line of work or that trade or business, but he also had rental properties and was managing those rental properties from his home office. So it was solidified there, as well as they pointed out the fact that just because he went to work, whatever, if it was 40 hours a week at the hospital, he still had his place of business for his rental operations in his home office.
Right. So that was solidified in this case. Also was solidified in the case is that the home was made a place of business and allowed him to deduct the travel. So this is a very key case, not only for landlords, but for other businesses as well, who are wondering whether or not they can, deduct the business miles to and from different business locations. So I just want to give an illustration to show just how impactful this can be. Let's say that you go and you buy a brand new vehicle for your business. Let's call it a Ford F-150. Ford F-150s just happen to qualify as a vehicle that could be potentially deducted 100% in the year that you acquire the vehicle. So let's say you buy that Ford F-150 and you drive it exclusively for business purposes from your home office to your rental properties and the related business locations that you have for when you run your rental business. So you're going to have 100% business usage in this case. And if you get 100% business usage, thanks to your home office, you can deduct the entire cost of the vehicle in the year you acquire and place that vehicle into service. So let's say the Ford F-150, you get a model that costs $50,000. Now, guess what? You're going to get a $50,000 deduction thanks to your ability to use the vehicle for business purposes. And a $50,000 deduction, let's just say you're at the 24% tax bracket, that's going to be worth $12,000 in tax savings to you. Now, if you're at the 37% tax bracket, that's going to be about $18,500 in tax savings. So it's not something to laugh at. Now, the issue is going to be whether or not you can actually make this loss that you get, or this loss from the vehicle, essentially active and be able to deduct it against your W-2 or other business income. And that's all going to come down to whether or not you're a real estate professional. Because if you've been following along so far, you'll probably see that this is all tied to your rental activity. All rental activities are passive by default for the purposes of whether or not you can deduct them against your other income. So any losses from your rental activity, unless you're a real estate professional, are going to be passive, including the loss that you'd get from a vehicle. So if you're not a real estate professional, you purchase a vehicle and you get a $50,000 deduction, it's going to be considered a passive loss, and it's going to be suspended and carried forward into future years when you either have passive income, perhaps from your rental properties, or you sell one of your rental properties for a gain. The losses can be unlocked. So it's still very beneficial to do this, even if you are a passive investor. And it's even more beneficial to do it, of course, if you are a real estate professional, and you could turn that loss non-passive and use it to offset your income from other sources.
Yeah, absolutely. One of the other questions you get asked pretty regularly on this too is, do I have to have a four walls, closed off space that is an office? And I say the answer is no. The space just has to be a dedicated space, used for your business. So you don't have to have an entire spare bedroom. Yes, it is going to be easier to illustrate and document, of course. But if you pull up publication 587, which is the IRS publication that governs everything, all the ins and outs of the business use of a personal residence. It's not even very far in. It's on page 3, where it's addressing the exclusive use test, and it's addressing the fact that this space has to be exclusively used for business. The wording that they finish the first paragraph with states the space does not need to be marked off by a permanent partition. It says the area used for the business can be a room or other separately identifiable space. So, it's you don't necessarily have to have a red line in the middle of of the carpet or whatnot. But I think that's important because as long as you can have that justifiably separate space where it's okay, this is where my desk, my computer, my filing cabinet is even supported a little bit again in the Curfee text, where they are basically laying out exactly what he had in the room, equipment wise, like including a desk, including a telephone. They even went so far as to address like the closet space that he used to store all of like his maintenance materials, paint and stuff like that. But the main point being is, you don't have to have a spare bedroom to turn into an office necessarily to take this deduction. You just have to make sure that it is dedicated for that purpose. And one of the best ways that you could probably document that, especially, is just take a picture of the room, of the space, maybe even a couple of pictures to kind of really outline, okay, like this, you can see that this is definitely my workspace. It's not an office, but it's definitely a dedicated workspace. That way, especially if it's in a case where after you have moved, you may not even have access to the space anymore. If you were in an audit situation, you have excellent documentation right there to be able to say, it was off the side of the living room around the corner, but here it is. It was dedicated for my home office space.
So the bottom line here is the home office for landlords, the home office deduction is not really for the home office deduction in and of itself. It's really to establish your home as a place of business so you can maximize your vehicle and local travel related expenses by making your home a place of business. That's the bottom line. So anybody out there who's wondering if you self-manage your properties and you're doing a lot of local travel, a home office probably makes sense for you. Again, you want to discuss that with your tax advisors to make sure, but chances are if you're playing an active role, home offices make sense.
So another question that we get pretty regularly too is, how, what can I deduct for my home office space? And it kind of boils down to the fact that there's actually 2 different methods. There's the actual expense method and the simplified method. The actual expense method is going to incorporate basically all the bills and expenses that go into maintaining a home. So those are going to be things like your property taxes, mortgage interest, your property insurance, utilities, internet. If you've got internet that's able to be separated out from cable, I don't think you could really justify cable as as an expense of the home office per se. But when you compile all those expenses for the entire year, then and that would even include like repairs and maintenance as well on items like that are going to factor into the maintenance of the entire home, like roof repairs. Once you factor in all those expenditures, then you would be then you'd have to allocate your the square footage of your home office based off of what the percentage of the home office is out of the entire square footage of the house. So, if your home office takes up 15% of the space in your home, then you would be allocating 15% of all of those expenses to your home office. They can be fairly cumbersome, of course. I mean, that's a lot of receipts, bills, and things that you've got to keep track of. So a lot of our clients are a little bit more geared towards the simplified method, which is very aptly named. It's much simpler. And what you do is you just measure the square footage of your home office and multiply that by $5 with a maximum of 300 square feet. You don't have to keep all the receipts from all those expenses like insurance and taxes and things like that. but makes it a lot simpler, a lot easier as far as reporting that onto your tax return. And the other item that this kind of plays into a little bit more often too, that we get a lot of questions on is, this rumor, this idea that claiming a home office deduction is actually going to increase your audit risk or somehow expose you to an audit if you claim the home office deduction.
Right. And there's no real evidence to really conclude that. What ends up happening, at least from my understanding and my experience, is people end up getting audited for Schedule C. And in connection with that, they end up getting audited for their home office as well. Along with that, sometimes this is what the IRS does. They find one thing and then they decide to kind of see what else they could poke and prod around while they're there. So there really is no hard evidence to conclude that because you claim the home office deduction, that in and of itself is going to create an audit scenario. Secondly, when you take the simplified method, it's usually going to result in a lower audit rate, because the simplified method is really simple. You're taking $5 per square foot up to 300 square feet, and that's a $1,500 deduction. There's not that much room there for you to take advantage. Whereas if you use the actual method, you start taking a portion of your actual expenses. Well, now there's a lot of room for you to kind of take advantage. Maybe you're buying things excessively for the home office and claiming really large deductions. And that's something the IRS is going to take a look into. And if you look back at what Justin said before, you're also going to need to have a lot more substantiation when you do take those expenses, and just put yourself at a risk for if and when you are ever audited, God forbid, for a home office deduction, and you are using the actual method. If you can't generate all of that substantiation for that, that's an opportunity for the IRS to go ahead and disallow it. So kind of the bottom line here is, there's no conclusive evidence that shows that home offices actually do increase your audit risk. And when you are audited, there's usually a lot more for the IRS to go on when you use the actual expense method versus the simplified method. And if we're tying this all in here for landlords specifically, if you're running a different business and you're not running a rental business, the conversation is a little bit different. I'm zoning in right here for landlords specifically. And again, because you're going to have a rental loss for the most part, or most landlords are, or you should have a rental loss, the simplified method's probably going to be the route to go, just because you're not going to be getting a tremendous benefit from the home office deduction in and of itself. So better fly under the radar, take the simplified method, and then just really, again, where the real perks of taking a home office deduction are for landlords, or establishing a home office rather, is the ability to turn your home into a place of business to increase your business miles. That's really the key. And that's why you should take one if you're eligible to take one.
Yep, couldn't agree more.
So I think that's about all for today. Thanks for tuning into this episode. Before we leave, I did want to let everybody know about our Tax Smart Bootcamp that's launching this upcoming Monday on January 10th. It's a 4-week course where Brandon goes in depth on the real estate professional status, short-term rentals, as well as repairs and improvement deductions. We're going to have a weekly live Q&A on Thursdays for anybody who wants to come and answer questions. The price of the course is traditionally $397, but if you're listening to this podcast right now, I'm not going to post this in the show notes. This is just if you're listening and you made it to the end of this podcast, you can get the course for 50% off by using the code capital JAN, so that's Jan, 22 exclamation mark. Ready? So you have to do, go to www.taxsmartinvestors, click on courses, go to the Tax Smart Bootcamp, and use promo code capital JAN 22 exclamation mark. So that's shift 1, right? And you're going to be able to get the course for 50% off. And that's only if you listen to this podcast and stay this long, because that promotion is no longer in play. So we look forward to seeing some of you in that bootcamp. But if not, we'll see you next week on the next episode of the Real Estate CPA podcast.